Good morning, everyone, and welcome to the monthly economic briefing presented by the Kenan Institute of Private Enterprise at UNC Kenan-Flagler Business School. I'm External Affairs Assistant Director Rob Knapp. It's great to have you with us this morning. Now, you've heard of a lot of this from me lately. We have a lot to talk about this morning, so we're going to get right to it. Our presenter today will be Dr. Gerald Cohen, who is the Chief Economist here at the Kenan Institute. He'll be on in a moment to talk about this morning's jobs numbers and lots of other things. Lots of news coming out of Washington talking about if we're seeing that in the jobs numbers and where we might see it in economic figures going forward. So that's to come. Dr. Cohen will present for about 20 minutes, and then we'll take questions from attendees. You can ask questions at any time during the briefing using the Q&A function at the bottom of your screen. If you're with the media, please list your organization with your question. We'll be sure to prioritize those questions and get them answered for you. If you're with us by phone this morning, you can ask a question. You can email it to me at rob_knapp@kenan-flagler.unc.edu. Briefings usually go about 30 minutes. We hope to be done around 9:30. You'll have plenty of time to get your 10 o'clock. So as I said before, Gerald Cohen's joining us this morning. We'll go ahead and bring him on now. He's been working feverishly for the last 30 minutes with the new labor numbers. So we'll see what he has to say. Gerald, good morning. I hope you're doing well.
Good morning, Rob. Just making sure my video is not yet up, but hopefully that will be Corey, there we go. I just got the option to start my video.
Hi there.
Hey, good morning.
Good morning.
The good news is that this report is relatively benign. And so we have a lot to discuss. And so I might actually spend a bit less time on the report than I normally would. And we'll kind of spend time talking about other issues, animal spirits, the kind of psychology around the economy, and the hard data, which as the title indicated. So let me share my screen, and we will go from there. Okay, and start the presentation. Okay, so just to go over the numbers, payrolls were up 151,000, as you can see, versus expectations of 160,000. Earnings, effectively, you can see this from this chart, generally in line with expectations, a little bit more weakness on the unemployment rate and the labor force participation rate, but effectively a report in line with expectations, with small net revisions. And so that should make people happy that the economy continues to perform well. And so that maybe I would say that everybody should be, there's been a lot of worry, and everybody should be kind of breathing a bit of a sigh of relief to say, at least as of February, and this data really reflects mid-February, because this data is based on a survey taken in the week that includes the 12th of February. So in mid-February, job creation continued to look healthy. So as I mentioned, 151,000. The 3-month average is 200,000. That's the orange line. We're growing still actually growing above what population or demographics indicates, between population and the domestic population and immigration. Question is, given what's happening on the immigration front, we actually could be run out of workers. I think that tension is a little bit: are we going to run out of workers, or are we going to have a slowdown in the economy? But as of yet, it looks like we have enough workers, and we have enough job creation. Unemployment rate ticked up to 4.1%. That was a combination of a decline in the labor force, so that does suggest some loss of workers. There's a lot of month-to-month volatility in these numbers, especially the labor force numbers, and the so I don't read too much into it. The unemployment rate remains very low, relative to history. So again, kind of this is indicative of a healthy economy. Labor force participation declined to 62.4%. Still yes, sorry, that's the left. That's the left axis, just making sure my chart was right. There is this, to illustrate the demographics, we're seeing, prime age, that's 25 to 54, so I'm no longer a prime age worker. The prime age workforce is, kind of hovering around record highs. But you have the 55 and older who are less prone to work on average, not me, but others, and it's really, the number really gets pushed when you're above 65. And so that number is just the population of folks that are 55 and older is increasing, and so that's what's pushing down the labor force participation rate. This is, if you have one number that worries me, and this chart doesn't do a good job illustrating it, that in this report, it's that the hours worked in the first 2 months of the year are down at a 0.5 percentage point annual rate. So hours worked have fallen. And for those that know my kind of GDP calculation, you've heard this many times, that the two components that make up GDP are people working more hours or increases in productivity. And it could be more. It's generally more people working, which increases the total number of hours. It's not people increasing their hours in general. That has been on a long-term downward trend. So what this means is, if this trend holds in March, then that means the only way that we're going to grow is through productivity. Now, yesterday's productivity report indicated healthy productivity growth up at a 1.5% rate for Q4, 2% year on year. So if, say, we get that minus 0.5 for the quarter, and we get plus 1.5 for productivity, you're going to get GDP growth of around 1%, which is a little in line with you'll see a more pessimistic outlook, but in line with kind of the general view of economists across the street, that growth is slowing in the first quarter. You'll see why in a second, but it's still going to grow. But there are some more pessimistic views, and I'll talk a bit about that. Average hourly earnings up 4% year on year. That gap between the blue line and the orange line is what effectively inflation-adjusted wages are. And so because we've seen a tick up in inflation-adjusted wages are still positive, growing, but they're growing at a slower pace than they have been for the last year or so. And so you're seeing some slowing in that because of the tick up in inflation. And again, talk a bit more about inflation and inflation expectations. So finally, I just want to kind of level set on two things that are related to more long-term economic issues that we're going to get into. So effectively, 60% of over 20% of our job creation has come from government, and 45% of our job creation over the last year has come from healthcare. And the question is, are those at risk given the cuts in government spending that's happening from DOGE or government employment? The latest data, so this is the yearly data. The latest data suggested that we are seeing some weakness in that. Government sector did create jobs, 11,000. And by the way, much of the government job creation comes from state and local governments. And so you could say, well, as long as the federal government cuts don't affect that, then it shouldn't be bad. But there is an impact between the federal government, especially when they're cutting budgets that impact state budgets. Think about all the funding, for projects, the EV projects, things like that. Or charging projects. A lot of these, and I'll say in the university, NIH funding, things like that can affect state and local government. So that is the black line, black area, which represents 20% of employment. It's still growing, but it is growing at a slower pace than it has been over the last year. Healthcare continues to look healthy. It's up. It represented a little bit less than that 45% in the month, but it's roughly the same. So just a concern of where jobs are going to come from, given the cuts that we're seeing in spending and in employment. Another area that I want to mention are tariffs. And I just want to kind of tell people, just indicate some data about what we've seen in the past. So in January of 2018, the Trump administration imposed tariffs on iron and imported iron and steel. And by the way, this is tariffs on iron and steel have been a long time issue. These companies tend to push governments to impose these tariffs. So both the left and the right have done this. And I just want to show you what we've seen. So the blue line is the employment in primary metals, which includes iron and steel and some other non-ferrous metals, but just it's the best measure that we have for a long history. And the orange line are what the production of those metal products. So you turn iron and steel, you turn steel into a fender, although a lot of fenders these days are plastic. And note the scales. On the left, primary metals, the employment went up from January 2018 to January 2019, roughly 10,000. And while the number went up for fabricated metal products by 20 or by 20 or 30,000. And so the fact is that the users of metals are much larger than the producers of metals. And economic analysis has shown that if you net out the trends and all these things, you could see that they were both on an upward trend. But then what happened is a year into it, we started to see declines, in particular in employment of fabricated metal products. So as I indicate on the right, research indicates we gained 1,000 jobs of steel production, and we lost 75,000 jobs of the users of that steel. So you have to remember the downstream effects of these tariffs. So turning to other concerns that are coming from policy, one of the things that have really been worrying the markets, worrying economists, is the big drop in consumer sentiment that we've seen. And we talked about consumer sentiment before, and noted that the Michigan numbers are much more sensitive to inflation, and that we'd seen a bigger decline in those sentiment numbers than the Conference Board numbers. Well, in both cases, both measures dropped significantly. Michigan did drop more because it is more sensitive to inflation, and I'll show you those inflation numbers in a second. But that drop in confidence has people very worried. And in particular, what's driving it are consumer expectations. So people are saying, okay, the economy is good now, but I'm really worried about what's going to happen over the next year. Now, the good news is if that comes back up, then maybe people won't change their spending behavior, but it could translate, especially if people say, well, I'm worried, I'm going to stop spending. And I'll show you that maybe there's some data suggesting that. It's too early to tell. And the good news is the hiring, as we've just seen in February, looked good. So, and if people have jobs, they're going to continue to spend. But this sentiment can really play a role. Maybe I should say generally, when people have jobs, they'll continue to spend. But if people start worrying, that could cause a snowball effect and slow people's spending, slow people's hiring. Other measures, and Greg Brown pointed to this last month, where you saw a big increase in the measures of economic uncertainty. So what he showed was that number had kind of jumped up to above 150. We've now seen it jump above 225. It's just an index number, but a huge jump. It's actually one of the largest 2-month gains in uncertainty on record. And again, greater uncertainty means people are less likely to go out and spend. If you're a business, you're less likely to go out and hire people. You're less likely to make those capital investments. And speaking of businesses, the National Federation of Independent Business, which is a small business index, there's a measure of uncertainty from their surveys. In general, their optimism has been okay, but you're starting to see much more uncertainty about the economy. Now, I should note, small businesses are very much their big issues are low regulation and low taxation. And so this is an area that kind of should be feeling good about the economy, because they should be feeling positive that we're in a regime that is looking to lower taxes and lessen regulation. It's notable that this uncertainty measure jumped in February. The two other peaks that we saw, I don't know if you can see my cursor right here and here, were both around the election. So you see some uncertainty around the election. The elections get resolved, and then you see, and actually here as well, and then you see how the uncertainty, kind of declines. At least, whatever regime they're in, they know this is what it's going to look like. But in this case, we've seen a jump back up to levels not seen other than during those election periods. I mentioned inflation expectations, so let me just show you them. So this is short-term inflation expectations from the University of Michigan. They asked people, and as I said, that survey has a significant dependence on inflation. So we have this read and a long history of this. They asked people, what do you expect inflation to be over the next year? And over the last 2 months, you've seen a jump of 1.5 percentage points. That is the same jump that you saw in 2021 when inflation had risen to, in the spring of 2021, and when inflation had risen to over 5% and was headed higher. Here, the inflation numbers, I'll show you in a second, there's been some pickup, but there's not been this level of increase. And so this is worrying to me, it's worrying to policymakers, because if people are worried about inflation, they're going to act on that and either pull spending forward, try to go out and buy more stuff, which could actually be inflationary in its own way. They might start to ask for raises or act in ways that could cause inflation to trigger higher inflation. This kind of it's a negative cycle of inflation. At the same time, market-based measures, so this is the 2-year inflation expectations from the bond market, have also risen. Not as much, but they've also risen. Again, very worrying to policymakers. The actual numbers of inflation are also showing this. You're seeing, this is the headline CPI. This is the worst chart of all the inflation charts that I could show you, but this is the one that people are most, it makes the headlines. So you've seen a reacceleration of inflation. It's still, it's not as high as it was in 2021, although people are acting like it is for the previous chart, or at least that survey of consumers. But it's moving in the wrong direction for the Fed. This indicates that the Fed will not be cutting rates, in my opinion. The core measures don't look as bad. They're definitely not decelerating, but they're kind of flatter on the growth rate. They're kind of stuck at this 2.5–3% rate. But the headline numbers and egg prices matter, are driving this. Food prices. So food and energy are kind of driving this higher. The core numbers are kind of doing okay, but not okay enough for the Fed to kind of feel like they've ended the inflation war. So talk some hard economic data. So this is the monthly consumer spending numbers. We got this a week ago today. And what it showed in January was a decline in spending. Now, as you can see, the blue bars is overall spending. The orange bar is spending on goods. These numbers from month to month can be quite volatile. And as you can see right here, January, the last year or few years, you've seen an increase in December and then a decrease in January. So the question is this the normal pattern? of, kind of, or I mean, I wouldn't say normal because it can vary, but the last 2 years we've seen this, last few years we've seen this, a pattern of, strong December, weak January, and in particular in goods, or is this something where people are acting in advance of tariffs? They're saying, I better buy that washing machine before prices go up. And so people were kind of spending and you heard some anecdotal evidence of this. People were spending in December, and the spending slowed in January. You have to see a lot more data for me to say that this is not just kind of volatility. It is notable that where it came from is goods, which is where you're going to see import prices have or tariffs have the greatest impact. Lastly, speaking of tariffs, yesterday we got numbers on the trade balance, and this number was awful. The biggest trade deficit we've seen ever. Some of this is because of some now I want to say quirks in the data. There's people have been importing gold because they're worried about there was a big spike in gold imports because people are worried about the impact of tariffs. And so there's been a big import of gold, but there's no way you definitively have to say that this widened because people were importing more in advance of tariffs. It could, so at least in the near term, the trade deficit is widened substantially. Some of this will, if companies are just stocking, it will go into inventory, so the impact on GDP won't be that big. And thus, I'll end with this controversy, which is the Atlanta Fed has a number called GDP Now, where they add up the data to date and come up with an estimate of GDP. That number is, sorry, I'm just checking my time. Oh, all right, I'm done. And that number, their estimate, at least of the data to date, suggests that GDP will fall at a 2.4% rate in the first quarter. Where does that come from? That kind of medium blue line, I guess the good combination of Carolina blue and Duke blue is net exports. And they're saying that the previous number is going to lead to a big drop in the trade deficit, which is going to flow through to GDP. Other economists are saying, wait a second, some of that is gold, and the other part is just going to end up in inventories, and so you're going to see an offsetting effect. The general consensus is that the first quarter will still have positive growth, albeit slower. If you take where I started about the hours work being down 0.5%, and you add productivity of what we saw last quarter of 1.5%, you'll get that 1% GDP, which is in line with what other people are saying by adding up all these pieces. So this number, I think, is an overstatement of the weakness, but we only have January data and we have our first read on February. So there's a lot of water that has to go under the bridge before we get a good read on the GDP numbers. So kind of where I started, or where the headline is that there are some worrying signs, in particular on the confidence, on the soft data. The hard data is doing okay, and this payroll number suggests that as well, kind of where I said benign, but it remains to be seen how the impact of these policies and the concerns about inflation. So let me stop there and open it up to questions.
Thank you very much, Gerald. I'm not going to say what I normally say here because we have a question from Dan Barkin at Business North Carolina. Good morning, Dan, and who's always all over it. And it relates to what you just spoke about. So consider this sort of an extension of your normal time. Dan had asked, how should we use the Atlanta Fed GDP model that estimates a negative Q1 GDP rate? And you just talked about that, but if there's anything you didn't say that you would like to say if you had a little more time, this is your little more time.
So I think I just want to stress that all they do is they take the data that we have in hand, and I mean, they put it into kind of a model that forecasts what's going to happen. But I think that if you take those negative numbers that we've seen, I mean, it's all about trade, and so I think you need to say either trade is going to that big big deficit, the increase in imports is going to lead to, inventories or you're going to see some reversal, then that decline will go away. So I think it's what I will say is it's too early to tell. It's not a great sign. I wish it were positive. I think that, but it's too early to tell.
Okay, very good. Thank you. Now I'll say what I normally say. Everybody out there, if you have a question for Dr. Cohen, you can ask that using the Q&A function at the bottom of your screen. Also, if you want to ask a question by phone, if you're with us by phone, you can email that to me, rob_knapp@kenan-flagler.unc.edu. Okay, back to the questions. This one's from Barbara Stenich. Good morning, Barbara. We were told that the F&A standards for research grants differ between federal life sciences, such as NIH, and she notes 26% to 28%, and private foundations, 0% to 15% plus. Given the reduction in F&A from 26% to 15% for NIH grants, what do you see as the potential impact for UNC Chapel Hill, a university that has earned a lot of NIH research grants? Can UNC adjust in a reasonable way?
So I don't want to speak about. I mean, I would say I'm not the right person to ask in terms of the math on this, or the impact of UNC on this. I should say I know there's been a lot of emails, and been reading them from the Chancellor on research. I think that this. So in theory, you could argue that over the fullness of time, you could put the overhead into the research grants. Like, the money is fungible in theory. So you could say, that rather than the university saying, well, overhead is all the stuff that, the stuff that runs the lab, you actually just incorporate that into the grant. But I think that I don't think that that's the intention. The intention is actually to cut funds for research. And I do want to actually make a push, because the Commerce Department just cut funding on two committees that work on economic statistics. And so without those, we're going to get less accurate economic statistics. So I really want to say, we cannot we cannot understand what's going on in the economy or make good policy without the best economic data. And the U.S. has historically had the best economic data. It's not perfect. It gets revised. That's not political. It's the statisticians doing their job. But if we're not working to maintain our existing statistics and improve our statistics. And the key is the economy is changing. We're talking about AI. How are we going to measure AI if we're not kind of improving those statistics, the impact of AI, if we're not improving those statistics, or the way we work, i.e. work from home, if we're not spending money on those statistics. So I worry about funding cuts to research and funding cuts to, our government statisticians. And the challenge is, and this is a risk for the triangle, is that we are an area which is highly dependent and benefit from research. A lot of startups, and those startups depend on the three great universities that are in the region, and those three great universities depend on federal research, because that's the federal government does support basic research that is not going to be supported by, or in many cases, not going to be supported by the private sector. And so that's what worries me. And so it concerns me both for our long-term future, but in the short term, there is likely potentially to be pain in the triangle from these cuts. So in the fullness of time, if the government decides, well, we want people to acknowledge that this overhead seems really high, but we're going to give you this money as long as you justify, you change the overhead into yes, it costs you money for labs. And I think the universities, that's what they're doing. They're charging you for the facilities, they're charging people. And so you could rejigger that, but I don't think that's the point.
Okay, on we go. This one from Jeff Miller. Can you talk a bit more about tariffs and the debate in Washington that it is paid by governments versus consumers?
There is, I actually have here's a chart that I have about that. So tariffs are paid by consumers is the answer. The share that they're paid by consumers is really depends. But early in 2018, the Trump administration increased tariffs on washing machines to kind of fight imports of washing machines. What you actually saw, and this is the blue line, is that I regret that I should make this a cleaner, I should go with a cleaner chart. What you saw, the blue line, is that you saw a 20% increase in not just washing machines, but in dryers. And dryers were not subject to tariffs. But what happened was the companies that were subject to tariffs said, well, you don't buy a washing machine generally alone, you buy them in a pair. And we sell them at the same price point, even though washing machines are less actually dryers have higher profits because they're less complicated, but people buy them at the same price. So they said, we're not going to raise just the price of the washing machine, we're going to raise the price of both. And not only did LG and Samsung, who were kind of the target of this, raise their prices, but so did Whirlpool and Maytag and the US companies. And so what happened was you actually saw more than the tariff being passed through to consumers. Now, this is a special case, but unless there is a hugely competitive marketplace, you're going to see those tariffs, and none of the other, you're going to see those tariffs pass through. So I have no doubt that you're going to see these tariffs pass through to consumers. The extent of it depends on a lot of factors, but you're going to see it.
Okay, thank you. Consider us in the lightning round now. We're a little past 9:30, but we're going to get this done. Question, and I think this refers to maybe a specific chart or something that you mentioned. These gold imports are not used in actual production, so wouldn't they be excluded from official GDP calculations?
Yes, so that's part of the rub. So exactly. I mean, some gold can be used in actual production. I mean, if you buy gold if you buy gold ring or you buy gold that's, yes. So that's a very perceptive, and so this is where I'm just I don't have enough insight into the GDP now model to understand why they're not offsetting that. But that's why yes, the answer is yes.
Okay, very good. Thank you. This one from David Mildenberg. Would a peace deal ending armed conflict and bombing, enabling Ukraine, agriculture and energy sectors to normalize, would that have a significant economic impact globally and more parochially the U.S.?
So you definitely saw early in the conflict, you saw an impact. I mean, Ukraine is a big exporter of producer of wheat, exporter of wheat. I think some energy, some the rare earth minerals. So you would definitely see some, and while the U.S. exports wheat, it's a global market, and that's what I think people don't understand. If we have lower oil prices, but the oil price, if we can produce a lot of oil, but oil prices are high, the U.S. oil prices are going to be high, or else we'd export it. So it definitely would help, the inflationary outlook. But I don't think that's what people are worried about. I think people are worried about tariffs. I think that's what's pushing the inflationary outlook less than I mean, there would be some positive impact, clearly.
Okay. Thank you on that. And this will be our last question. If consumer confidence continues to wane and inventory was built up, would Q2 and Q3 be a sharp drop economically?
That's my concern. That's exactly my concern, that effectively people say, I'm worried about the economy, I'm worried about my job, I'm going to stop spending, and then so you'll see, and then that kind of drives kind of a vicious cycle. That's the term I was looking for before. And then I will say, when I was, if you run the numbers on the impact of psychology of kind of these confidence, or the impact of the stock market, even in, when the stock market is down 10 or 20% on the economy, the numbers are small. The way these feed through is psychology, and this is kind of why I wanted to talk a little bit about animal spirits. So it's really in the 30 years I've been an economist, there have been a number of times where it looked bad, and the American consumer, American businesses looked past it. I mean, and the economy kept going. And there are other times when it looked bad, or it didn't even look that bad, and it got worse. And so so the animal spirit psychology, I mean, that's kind of Keynes's view, plays a hugely important role. And so we don't know the exact mechanism. My colleague Cami Cunin, who's a neuroeconomist, talks a lot about this, but it's hard to know, hard to predict. But that's my concern. And I'll say the job numbers are going to be a key thing to watch, job and spending numbers. So tune in a month from now, because I think if we continue to get job growth like we did today, I think we'll be okay. If they start to wane, if spending numbers continue to be weak, I'd worry.
The hard data. Dr. Gerald Cohen, thank you very much. Not only an analysis of the employment report, but pretty much the broad U.S. economy in about 20 minutes, plus a good 15 minutes of Stump the Band. So you can go home now. Your day is over.
I wish I have to be grading now. I have papers to grade. So.
All right. Well, thank you very much, as always, for that. Thanks also to our attendees. Your questions helped drive the show, and you had some wonderful ones today. We had a lot of ground to cover, and you helped steer us towards some interesting things, or back towards some interesting things. We appreciate your input very much. For those of you in the media that joined us today, we'd love to continue the conversation. If you'd like to talk to Dr. Cohen or any of our other experts about anything the Kenan Institute is involved in, please let me know. You can email me at rob_knapp@kenaninstitute.unc.edu. We hope everybody will take a look at our website, which is kenaninstitute.unc.edu. I even wrote a note to myself to tell you what's new on there. We've got part of our grand challenge this year, which is about the skills gap. We have a new piece up on artificial intelligence and the skills gap that we think you'll find interesting. There are a lot of other things coming up very soon on there as well. Also, there's our collaboration with Fifth Third Bank called Empowering American Cities. We're doing a series on Mythbusters on manufacturing. We have one of those up. There will be more to follow. We think you'll find them very interesting, and that's at empoweringamericancities.com. Also, if you haven't followed us on social media on LinkedIn, give it a try. We're in several places on social media, but I think I can safely say that we probably do more than anything on LinkedIn. So if you're on LinkedIn and you're not following us, you might take a look. Lots of interesting things there. We're going to get you out of here for your 10 o'clock. Thank you very much for joining us today. Gerald mentioned Camelia Cunin, who I believe is going to be our host in April, and will have some things to say, I'm sure, about consumer confidence. So get ready for that. We hope to see you then. I believe it's April 4th. In the meantime, thanks again, and enjoy your Friday.